Welcome to our channel Stocks in the USA. Today, we will discuss news that came out just a few days ago concerning one of the most famous and well-known REIT, real estate investment trust companies in the U.S. stock market. Do you want to know if this operation will benefit shareholders? Or if it's better to sell before it's too late? Stay with us until the end of the video because we will gradually reveal all the key points of this operation, both positive and negative. Before we dive into our analysis, remember to subscribe to the channel, give us a thumbs up, and hit the notification bell to stay updated on our new videos. If you haven't figured it out yet, we are talking about Realty Income Corp. The monthly dividend company. More specifically, we're discussing the announced acquisition by Realty Income of Spirit Realty Capital, a company that shares many similarities with Realty Income. After the announcement, the markets reacted as they usually do in such cases. Realty Income's shares saw a nearly 6% decline, while Spirit Realty's shares surged by almost 8%. The question on the minds of Realty Income shareholders, along with all market investors, is whether this operation is advantageous for Realty Income and what the short, medium, and long-term consequences might be. To answer these questions, we've analyzed the details of this acquisition and provided our own assessment. Realty Income will acquire and merge with Spirit Realty for a total cost of $9.3 billion, which will be paid with Realty shares at a 15% premium to Spirit Realty. The operation will need final approval from both companies' shareholders and, presuming there are no unexpected hitches, is expected to be concluded by year-end. This deal represents around 15% of Realty's market capitalization, with a significant impact on its underlying business and cash flows. It's also Realty's largest deal since the merger with VRET in November 2021. The merger will result in an enterprise value of $63 billion and an increase in the number of properties in the portfolio to a total of 1,582. The fund's occupancy rate will rise to 99.1%. The new distribution of properties by type will be as follows: retail 79.9%, industrial 15.1%, gaming 2.2%, other 2.8%. This operation will make Realty Income the fourth largest REIT traded on Wall Street, advancing 3 positions from its current 7th place. Simultaneously, it will confirm and strengthen Realty Income as the top REIT company in terms of daily trading volume in the last 3 months. Of course, with transactions of such magnitude, there are inherent risks, especially for the acquiring party. The 2 main risks are: number 1, the risk of overpaying relative to the value that could be extracted through the acquisition. Every extra cent paid above the fair price of the joint business's shares has a significant impact on comparable wealth creation for existing shareholders. Number 2, the second, less observable or quantifiable risk is the ability to realize synergies. A well-calibrated integration plan is needed to combine large portfolios and, through efficiency, ensure some cost savings. Adding about 15% to the business is not a simple task, and any mistakes could lead to significant consequences. So what could be the advantages of this merger? Number 1, first and foremost, Realty has announced no intention to reduce its current dividend. The current dividend is $0.256 per month and is one of the fundamental points that distinguishes the company. Number 2, in a high interest rate environment, bigger is better. This provides more leverage when dealing with credit institutions, especially in negotiations and debt renegotiations. Number 3, an improvement in Realty's capital liquidity should help raise new proceeds through public and/or private placements. It also enhances Realty's standing in the eyes of credit rating agencies, which consider the size and diversity of credit issuers. In other words, having greater size, diversification, and a balance sheet by definition exerts necessary downward pressure on the cost of capital. Before we continue, if you're enjoying the video, please subscribe to the channel, give us a like, and hit the notification bell to stay updated on new videos we'll be posting. Thank you. Number 4, Realty and Spirit's operations are quite similar, with a high degree of overlap. Lease contract structures, property types, sectors, and balance sheets are relatively homogeneous. This makes us less concerned about Realty's ability to unlock synergistic value. Number 5. Furthermore, the deal structure offers an almost immediate advantage to Realty shareholders on a per-share basis. No additional financial risk is assumed, and the basic assumption of a 2.5% increase in AFFO, adjusted funds from operations, is very conservative. What do you think about Realty Income and REIT stocks in general? Let us know your opinion in the comments, and also tell us what topics you're interested in for future videos. Based on our evaluation, this operation appears to be positive for Realty Income shareholders, especially given that the stock is currently trading well below the company's average market value. Today, the stock is priced at just over 47 cents, down 27.5% since the beginning of 2023, largely due to high levels of inflation and interest rates. This makes the current valuation very appealing, especially from a long-term perspective. Realty currently offers a strong dividend of 6.48%, and when combined with the discounted share price, it presents a stock with significant growth potential. The lowest conceivable target price is at least $60, but with improved inflation and lower interest rates, Realty could reach and surpass $75. As always, we remind you that we are not financial advisors, and this is not an invitation to buy, but rather our analysis based on our experience in the stock market. We encourage you to conduct further analysis and ultimately make decisions with your own judgment, as your money is yours, and you should be aware of where you want to invest it. See you soon, investors!